In this week's update, what triggered Friday's massive reversal? Corrections are buying opportunities, and the rotation to commodity sectors is still in the very early innings. My name is Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Wow, what a finish to the week. It had been very positive for commodities until things just went parabolic, which made the correction inevitable. It was only a matter of when and what would it be that was the trigger to start it off. So that's what I'm going to try and unravel. So let's get stuck into it. So the explanation is not really that important, to be honest. I know we all like to put labels on things and we like to understand what has caused something so that we can anticipate what comes next, but you really don't need to. You just need to have a process that informs you what to do when the market does X, then you do Y. And that's really all you need. And anything beyond that contemplation is not only a waste of time, it's actually generally worse than doing nothing because it puts ideas in your head or expectations in your head. But anyway, you've heard me say all that before. But this is my view for those that want a label, need a label. This is my view of how it unfolded. And it unfolded all very, very quickly in the space of hours, really. So there certainly was commentary around markets during last week that big traders were expecting a nasty reversal at any time. And that started the ball rolling. So there would have been some preliminary selling that occurred, and there was certainly evidence of some preliminary selling during Thursday and the early parts of Friday. So the ball had started rolling. And the other thing that had happened is that over the last couple of weeks, that parabolic move had meant that a lot of stocks and commodities were trading like meme stocks. And you go back to post-COVID when we had those meme stocks just doing ridiculous things in a day, and that was what the speculative excess was starting to look like. And that meant that there's a lot of new, inexperienced hands coming into the market, what we call weak hands. They're not going to hang around when things get messy. And so we had a lot of new, inexperienced traders who came into the market, probably through social media, and they panicked, of course, because they just didn't know what the heck to do except sell. And then on top of that, there was rumours and then some degree of confirmation that the new Fed chair pick from Donald Trump is going to be a guy that is a bit more hawkish than some of the other possibilities. And so that means that the US dollar is likely to be a bit stronger than was otherwise thought. And then so that just added to what had already started. So the ball starts rolling down the hill and the weak hands add to it. And then the new Fed chair pick adds to it. And you end up with a cascade. And then, of course, inevitably, there will be the leveraged margin players that are getting margin calls. And it just all snowballs. So that is the overwhelming likelihood of what actually happened. But just for perspective, initially I was as stunned as many by the speed and severity. But as I kicked back and thought about it on Friday night and during Saturday, I just got more and more excited that this is an opportunity that comes along once in a decade, once in a lifetime, and perhaps is even better than any that we've seen in the last few decades, because in previous decades, the factors that had contributed to those megatrends turned out to be somewhat transient. The massive commodities bull run we got between 2002 and 2011 was because of what China was doing, but that was never sustainable. What we've got on our hands now, the de-dollarization, the get out of American financial assets trade, is not going to reverse. The AI trade is not going to reverse. These things will not be transient. So that says to me that this bull run is going to be more sticky than what we've seen in recent decades. So from my perspective, what has happened is that the drivers for the megatrends have only been enhanced. They've not been stopped. They've not been changed. They've just been enhanced. They've got better. So the overwhelming message from this video is don't be thrown off the game plan you've got, if you've got one, by just this abrupt, but will prove to be a transient upheaval. And therefore it's an opportunity. And it's one of the best opportunities you'll ever see. Because resets, we've had a reset grinding on for the last 6 months from high multiple AI and tech stocks. And that's been grinding away in the background, but not across the board, because there are many stocks, tech stocks in America, that have got unbelievably strong uptrends still playing out. So this is not a universal trend here. But resets always create better reward for risk. And this is a reset. Gold and silver and copper and palladium and platinum and lithium, they've all gone too far too fast. So this is a reset. It's actually very healthy. It's very necessary. So you should not look at this as a problem. You should look at this as an opportunity. The drivers of the rally, they're real and sustainable. So I'm talking about the rally that started a year ago, 2 years ago, 3 years ago, depending on what asset or what stock you're looking at. But around the whole AI data center narrative, the get out of America trade, the de-dollarization trade, the electrification trade, these things are real and they're sustainable. They're not going away. And more than that, they're going to accelerate. They're going to get better. It's just that they became too speculative in the short term. And that's just part of markets today. Markets today are far more leveraged than they were decades ago. It's too easy for inexperienced speculators to come into the market because of the platforms that are available now. So you've just got to recognize that we are in a world that is almost guaranteed to be more volatile. So what are the odds? Because I don't do predictions, I do probabilities, and I marry those in with weightings to reflect those probabilities and volatility. So what are the odds from here? Well, I can tell you that Friday in Australia and Friday night in America has shattered confidence in many areas. And so I expect that for a period of time, now whether that's a few days, a few weeks or a few months, I have no idea. And again, I'm not thinking about it, deliberately not thinking about it. It's not helpful. But just be aware that that confidence has been shattered and that will impact the liquidity on the buy side. So we will see some free-falling prices. It's a given. The only thing we don't know is how far and how long will it go on for. I suspect that we're now entering a period of broad volatile choppiness because there will be buyers willing to come into the market at a certain level, thinking that that's it, that's enough, and they will push the price up just because of the balance between buyers and sellers. And we'll get rallies, but those rallies will get snuffed out very quickly because there'll be people who are still long who don't want to be long, and they've just been waiting for a bit better price to get out. So they will sell into those rallies. So I just cannot see the prospect of a V-shaped rally here just because of the dynamics of human psychology. I just think almost doesn't allow it. Unless there were to be some dramatic news-driven event that suddenly depressed the US dollar again, then that might yield a V-shaped rally. But other than that, it's very hard to see. So the important thing for investors here is you've got to know how to pick entries. You've got to know what a good entry looks like. And we can never be sure that where we enter is the bottom. And again, you don't need to, because you just do that through weightings and stop losses and just good old general risk management. The harder part for investors that I've been getting told for the last 20 years is how to set exits. So that is the most important skill to learn, how to set your exits based on the balance between buyers and sellers. And to do that, you have to become prolific in being able to read price charts, and not just the last candle. We're not talking about a sudden one reversal candle that tells you the story. That's never the case. You've got to be able to read the whole play from perhaps 2 weeks ago or even several months ago to understand what is happening right now and to be able to pick those shifts in balance between buyers and sellers and who's winning. And I also suspect that there's going to be a lot of news in the next few weeks and that will feed into the volatility as well, both positive and negative. Just be careful that you don't become a slave to these news-driven movements because generally those things are priced in advance. And so if you're just following the news and trying to jump on that, it's going to be difficult. Let me just start off by showing a couple of charts. This is the silver chart, just to give you a sense of the volatility. This is a weekly chart. The last time we had a decent sort of decline was here in percentage terms, was here. And the decline was 16% from top to bottom. Now, this one only started on Friday, as you can see. Perhaps a little bit of insight into it on Thursday with this very wild doji candle was perhaps a precursor to that. But if we look at this on a weekly, this has only been running for one day, and we've already had, from peak to trough, a 33% decline. So that just puts in perspective the period that we've now entered. So that's another reason why I doubt that we're going to see a really, really quick resolution to this, like a few days. I just can't see that happening. And when we look at gold, this is also on a weekly chart, it was nowhere near as severe as silver. Silver's a much smaller market. It's therefore going to be kicked around a lot more by the leveraged players that are having their hand forced by margin calls. But nevertheless, we hit a high for the week, basically 5,600 US. And we also hit a low for the week of just under 4,700. So that is a $900 turnaround week for gold from top to bottom. So that just gives you a bit of a sense of the volatility that was involved there. Okay, it's always important to get all your advice lined up and squared away. But in markets like this, it's even more important to make sure that you're clear on what you're doing and not only the potential upside, but also the risks that are involved in these kind of markets. American stocks, the S&P ended up 0.55% for the week, so equities at the index level were pretty resilient. And the NASDAQ was down a little bit by just 0.2%. So that's across the week, but obviously some negativity on Friday. And the Russell ended up giving back 2%, not unusual, because a lot of those stocks were smaller cap material stocks as well. So the tariff package, I'd hoped that had gone away post-April 2025, but it's back again, and it's really tantamount to something like economic war, the declaration of war on countries, but doing it through economic levers and not through military levers. And so there is a distinct probability that we'll see some global supply chain disruption, and that is never helpful to a good positive market because no one knows where they're at. Now, it's not as bad as COVID, but it will not be inconsequential. And the fact that the president is as erratic in his decision-making as he is, flip-flopping from one side to the other, just all magnifies this. The US dollar index was 97.15. It was down about 0.3%, but that was after quite a strong reversal on Friday, thanks to the rumours around that Fed pick. So the US dollar broke support. It broke support very decisively. And then Friday, it all turned around. And the cynic in me wonders about whether this is a bit of a contrived move or not, because announcements can be timed to great effect. The 10-year yield hardly moved, 0.01, I think. And the VIX kicked up a little bit, but not too much, 17.4. So let's jump in and go and look at the relevant US charts. So we'll start with the NASDAQ composite. So this is a weekly chart. You can see over the last 5 weeks, really, we're at the same level that we were 5, 6, 7, even 8 weeks ago. And it's a very, very tight band. Now, if normal technical analysis prevails, then this tightness is a precursor to a breakout in the direction of the former trend, which of course was up. So the overwhelming odds are that the US main indices will break out shortly and to the upside, but that of course is not a guarantee. But again, that's just where the probabilities sit. Now, if we look at consumer discretionary versus consumer staples, and I was able to use this one to great effect back in 2021, post-COVID, so just here. So throughout 2022, when this ratio really, really fell over. Now, it's become a little less relevant than it used to be because of the dominance of Amazon and Tesla in the consumer discretionary index, but nevertheless, it does carry some worthwhile information for us. So this was the precursor to 12 months of downside in big tech. Now, we don't seem to be seeing the same thing at the moment, but nevertheless, we've got a lower high and we've now got a very short-term downtrend. So if we start breaking this low here on this ratio, which means that more money is going into consumer staple stocks than is going into consumer discretionary stocks, then that is something to pay attention to. It's just one more brick in the wall. You would never take action on this alone, but it's just one more piece of evidence that might validate what you're doing. The SMH index is always important, what the semiconductors are doing. This is a daily chart, and you can see there was nothing terribly nasty about Friday. So semiconductors weren't impacted. Yeah, it was a bit negative, but there was no real increase in volume. So that is nice and steady. If we go to the ratios or where the sector rotations are happening, you can see that XLB, which is materials, was clearly winning the battle and was going even better than energy. But then that all changed on Thursday and Friday, quite a dramatic rollover there for materials. And we've also had XLP, which is the consumer staples sector, also coming up quite sharply. And also just tucked in here, a bit hard to see, but XLV, which is healthcare also. And of course, right at the bottom where it's been for quite some time as this global reset of high multiple tech stocks plays out is XLK. If we look at the Australian market, materials were killing it. So was energy over the short term, over the last month. And I'll just get rid of that. Also, small caps were doing very well. They were doing much better than the ASX 200, which is this one here. But that turned over very, very abruptly predominantly on Friday, but also to a degree on Thursday. If we look at the S&P on a weekly, you can see there's minor move to the upside, and that was the Russell 2000. So that's the way the American market sets up. Now, just looking at currencies, this is on a daily chart for the US currency. Let's look at weekly, I think, is the first thing, and you can see clearly how we broke this important support level. So this takes us back to 2022. So this is the lowest price now in 4 years, January of 2022. So we broke it, and it was only Friday that really saved the dollar. Otherwise, we would have had not only a break of very important support, but we would have had a close below very important support. But the sharp rebound negates that for the time being. But you can only look at that chart and conclude that the trend is to the downside. A one-day blip doesn't really change anything. And if you look at the Australian dollar, we actually got up above 70 during the week, but that reversed to a degree overnight with that strength in the US dollar. All right, moving on now to the Aussie stocks. So just to summarise, 0.69 is where the Aussie dollar is. Great for overseas travellers. The ASX 200 index was down almost nothing, call it flat, 0.1% for the week. And XJR, the resources sector, XEC, the emerging companies index, and also the XSO, which is the small ordinaries, were all looking great until Friday. And then they got whacked big time. And we'll go and look at that. In fact, we'll go and do that right now. So we'll start with XEC. So that's the emerging companies on a weekly chart. So you can see, whilst it felt like there was a heck of a lot of damage being done during the day, if we put that on a weekly chart, it really doesn't look quite that bad. Daily looks a bit more nasty than it was if you were watching the market during the day, but certainly on a bigger picture view, it's only given back one step of 5 steps taken forward. There's the ASX 200, but the one I wanted to get to, this is XJR. So this is the 200 resources index, again on a weekly chart, first of all, but then on a daily to show you the very, very sharp reversal that we got. But it wasn't a lot different to the 21st of November or a couple of other instances late October. So we've seen this sort of volatility before, but I think this one, certainly in the precious metal space, is going to have more substance to it. Now, turning to precious metals, this is where all the seriously big action was. Gold was down, ended up down 2% for the week, but as I showed at the start of this video, the volatility was extraordinary, and it was a $900 turnaround from top to bottom. We ended up finishing just shy of 4,900, which is still an amazing level. It only takes us back a couple of weeks. In Aussie dollars, we go back a little bit of ground, back to 7,000 and change. But silver was where the massive move was. It ended up net down 17.5% for the week to 85. But the peak-to-peak volatility was enormous. It was 33%, or I can't remember the number, but the slide that I showed at the start. So incredible volatility in silver, and we also saw it in copper and a number of other commodities as well, were way up in the double-digit declines. So there was a whole bunch of factors feeding into this, as I covered earlier. It was profit-taking from the fact that we'd just gone exponential, we'd gone parabolic. And there are a few other things as well, but I mean, that's what happens. A cascade gets started by something, and then it does that. It just cascades on top of itself. We had excess run to the upside. We had the US dollar reversal. We had tariffs. We had a whole bunch of things. So it was a real perfect storm. But the key thing here to remember is that these fluctuations are about the paper market in gold and silver and other commodities. And we don't know to what degree those markets are being manipulated, but this is not what's happening in the real world, the physical world. The supply and demand situation for gold and silver and copper and everything else is not doing what we're seeing in the prices. That is, to a degree, a contrived paper market. So we need to be focusing more on what the physical market is doing, because that is where stocks are going. That is where the investment decisions are being made. So that's what you need to stay fixated on and not be thrown off by the volatility in the paper market. There's no guarantee around this, but I think gold should be the first to recover of all of the metals that got absolutely monstered on Friday and Friday night, because there is a whole level of safe haven flows here that are not going away. They've not changed one little bit. So I think money will start to flow back into gold before just about anything else. That's not a promise, but that's just the logical probability. Now, when it comes to gold stocks, the underlying trend in gold, and particularly in physical gold and silver, The underlying trend is even stronger now than it was a year ago. The catalysts are even clearer than they were a year ago. So from my perspective, the fact that we've just had this almighty reversal, a lot of it due to financial engineering in the paper market. But the way forward, to my way of thinking, is even clearer than it has been at any stage, and even stronger. So that's why I'm seriously excited about the opportunity. But the opportunity is not going to jump in your lap by just sitting there in the chair. You've got to have a plan. You've got to be very clear about it. You've got to be disciplined to that process. So what we're going to see in coming days or coming weeks is the weak, inexperienced hands who are just being driven by emotion. They're going to sell their stocks to us at a gift price. Now, I don't know where it is or when it is, but I know what it looks like. I know exactly what it looks like. So that's the important thing. We're not there yet. But of course, if you have no cash, then you can't take advantage of that gift. So I think a degree of cashing up, perhaps which overrides your normal exit rules, is not out of the question here, because the opportunity is going to be amazing. And the other aspect that's really important to recognise is that a lot of the small, early stage explorers and advanced developers haven't really moved that far. I mean, moving double or triple in a serious precious metals bull market is not very far. And they remain dramatically undervalued. They really do, on a long-term view. So if you think because you're looking at stocks that have doubled or trebled in the last couple of months that you've missed the opportunity, then you need to rethink that, because that is absolutely not the case. The only thing that we've got to be aware of is that in this kind of market, there is a whole bunch of dynamics that have got nothing to do with the merits of the stock. And it's likely that we're going to see some bounces and rallies that are going to get sold into fairly quickly, because that's just human emotion playing out. So just be aware that there's some market dynamics. Don't look at the price movements and think that they reflect the real value, because there are other players in the market that have got a completely emotional agenda, and they're going to do things that are going to override that. But at some point in time, the buyers will gain control again, and prices will resume the trend that they were on, because all the long-term drivers are still in place. So there's a weekly chart of silver. I'm not even going to hazard a guess where the bottom of this might be. We'll just wait and see. And the same with gold. Now, the other thing that I want to look at is the indices. This is GDX on the Aussie index. Now, there was some selling on Friday. This is a weekly chart. Let me just go to a daily. So you can see it was fairly nasty. It was fairly nasty on the chart. It was fairly nasty on the ground as well, and plenty of volume behind it. So the probability is that we will get continued selling. And from a purely technical point of view, some obvious support levels come in this range here. That would be an obvious zone of support. But look, it may not get there. It could go well beyond it. There is no way of knowing, and no point thinking about it. So that is the way that we look in Australia, and I'm sure that it'll probably be likely another decent red one on Monday. This is GDXJ. It's called Junior Gold Miners, but I can assure you there are a lot of very big market cap stocks in here, just not the absolute mega caps in the sector. So this was a weekly chart, and again, it's instructive to look at the daily. So we were going along beautifully until we got a bit of a reversal, but it did an intraday bounce. That wasn't terribly nasty on Thursday. But by the time the commodity prices fell over during our Australian and Asian trading session on Friday, that led, of course, to a massive gap down. We got a bit of a rally, but then it sold down and closed near its lows. So that's pretty ominous in the short term. All right, turning now to other commodities. Copper was up to 597 was the close. And last week I said that was technically at risk. That was a week ago. Partway through the week just gone, it looked even more technically at risk when we hit $6.50 intraday in the futures market. And that sort of escalation, that parabolic escalation, just begged a trigger. So from here, sideways to modestly lower is likely. So we've gone from $6.50 back to under $6. I don't know where the bottom might be, but the case for copper remains extraordinarily attractive. I think a couple of things need to happen here to let the copper market settle. There has been a level of speculative positioning that has to reset itself. Now, that'll happen probably fairly quickly because margin calls, they don't give you a month to meet margin calls. They're pretty quick. So the speculative positioning has got to reset before we can kind of get to a bottom. Also, too, we need the tariff impact to become clearer. Is he going to do it? What impact's it going to have? All those sorts of questions. And we also need to understand what China's going to do or is doing with their stimulus, particularly into their domestic economy. So all those things will impact on copper, but the long term for copper is undisputably really, really strong. And for copper miners, I think we can expect a period of consolidation. Again, as with virtually everything, because it's been driven by emotional psychology, the rallies are going to be met by trapped longs who are looking to get out. Now, what could change that picture, that this is going to take a little while to stabilise? Well, if Trump backs off, if he does another chicken out, any de-escalation would lead to a pretty powerful rally. So that just all feeds into the uncertainty of where we are, which is why it's so essential to have a clear process built around managing risk. Crude oil shot up to 65.74. There's plenty of things happening there. We're getting spikes on headlines. But overall, it's really just kind of range bound. Now, there's the copper chart. This is an end-of-day chart. This doesn't show the intraday move, which went to $6.50 and above. But nevertheless, you can see we've had a bit of a pullback. Spot nickel, similarly, I think was down some 7 or 8% on Friday night. Aluminium also, which had been trending very strongly, it saw plenty of selling. So did lithium carbonate. So just about all commodities across the board got hit. Uranium had a fantastic week, was trading at 102 at one stage on the spot market. Eased back a little bit on Friday, but there's enormous strength in that market. And there's crude oil. And we're really in this range between 56 and 66, which is a pretty broad range, and it's very unpredictable. Final message today, this is the time when you really learn. You learn very little during bull markets when everything's just going along nicely to the upside. Here's where you really learn. Here's where you really find out just how good you are. And last week I said it was highly likely that there were massive gains ahead with extreme volatility. Well, we certainly got the extreme volatility. In fact, we really got a bit of both just in the 1 week. So the question is, are you equipped to handle this level of volatility, this level of uncertainty? And don't kid yourself, because there is an opportunity of a lifetime here. You want to learn how to play this well. And in my experience, most traders and investors are not equipped with process or psychology to handle what the market is going to repeatedly throw at us over the next decade. So when we're looking to the future, I think what is started is healthy, it's necessary. So look at it that way. Don't wring your hands and look at it as a huge problem that started last Friday that disrupted your sanity. This is healthy, it's necessary, and it's going to lead to some amazing opportunities. Nothing has changed in the long-term opportunity if you stay closely focused on the 7 mega trend areas and you've got a good process, then I think you're going to do really well. Having some cash obviously allows you to take advantage of some of those opportunities. Portfolio Analyst last week was very much about managing risk for the inevitable pullbacks. That was exactly what had to happen. There's nothing terribly clever on my part in terms of the timing. It was just when things go parabolic, they're not sustainable. We also covered my exit rules in depth. So 3 clear exit rules, and they really cover just about every eventuality. 1 fundamental, 2 based on technicals. And we also looked at a couple of early stage opportunities as well. So there will be opportunities galore in coming weeks. Just make sure that you're prepared for it. There's more information on the website, and there's my email address. And I'll be back with you next Sunday with plenty to say. Cheers.